What if Bitcoin wasn't just a digital currency, but part of a carefully orchestrated plan spanning decades? What if stablecoins like Tether weren't just financial innovations, but tools designed to shape the global monetary system? And what if the biggest moves in Bitcoin weren't random, but reflected the interplay between political chaos, institutional design, and human ambition? Mark Goodwin argues that Bitcoin's rise was never accidental. From its creation to the emergence of stablecoins, there's a human story of strategy, influence, and experimentation behind what many think of as purely technological innovation. The warning is clear. If you approach Bitcoin or crypto purely as a speculative asset, ignoring the macro and structural forces at play, you risk being blindsided. Mark emphasizes that understanding the broader system isn't optional. It's essential for anyone serious about preserving wealth, protecting financial freedom, or navigating the next decade of monetary change. Hello everyone, and welcome back to our channel. This podcast summary video is based on Mark Goodwin's recent appearance on What Bitcoin Did, where he delivered one of the clearest explanations we've heard about Bitcoin's origins, its role in the modern financial system, and its future as a store of value. The conversation dives deep into stablecoins, Treasury discussions, political incentives, macro cycles, and why Bitcoin may be evolving into something much bigger than a speculative asset. The whole episode is almost 2 hours long, but we listened to it all and organized the most important ideas into a clear, straightforward summary, so you get the key takeaways without having to listen to the full episode. If you get value from our summaries, please like the video, subscribe to the channel, and comment your thoughts below, because that really helps the channel and keeps this content coming your way. Mark starts by taking us back to 2014, when the concept of stablecoins was barely more than an idea, and Bitcoin itself was still small in terms of market capitalization. At that time, most blockchain projects were under $1 billion in total value, and pioneers like Mastercoin and Tether were only beginning to emerge. Mark raises a provocative question. Was Bitcoin simply a breakthrough technology or part of a broader plan involving governments and powerful financial networks? He notes the early interactions between influential figures and institutions, including discussions that would eventually bring Epstein into Treasury conversations about Bitcoin. Mark frames this as a chicken or egg situation. Did stablecoins exist to support Bitcoin's growth, or was Bitcoin itself an instrument shaped by early insiders to serve a larger financial agenda? While he doesn't claim to have definitive answers, he emphasizes the importance of understanding the human and political dynamics behind these financial innovations. Mark also explains how these early developments influenced adoption cycles. For example, Tether's creation in 2014 allowed Bitcoin traders to move between fiat and crypto quickly, smoothing volatility and laying the groundwork for institutional engagement years later. Without understanding this phase, Mark argues, it's easy to underestimate the deliberate infrastructure building that shaped Bitcoin's trajectory before the 2017 bull run. Mark is adamant that Bitcoin was invented, not discovered. He criticizes the idea that Bitcoin is some purely mathematical inevitability. Instead, he frames it as a deliberate human creation, crafted to compress trust, reduce settlement time, and minimize political risk in a way that no previous money ever has. He explains that the pseudonymous Satoshi Nakamoto could have been a single person or a coordinated group, but either way, the creation was intentional. Every aspect of Bitcoin, from its scarcity to its proof-of-work design, was carefully chosen to achieve long-term goals. Mark emphasizes that understanding the human intent behind Bitcoin is key to appreciating its resilience, its design, and its role in the broader financial ecosystem. Mark adds that this intentional design has ongoing consequences today. Many of Bitcoin's structural choices, like its fixed supply of 21 million coins, are political as much as technical. They ensure that the network remains resistant to manipulation, censorship, and inflationary pressure. For Mark, recognizing Bitcoin's human origin is critical to understanding both its durability and the reason it continues to attract institutional attention. One of the most eye-opening parts of the conversation is Mark's exploration of Epstein's role in early Bitcoin discussions and the wider financial world. Epstein, Mark explains, acted as a broker of immense influence, managing billions for families like the Rothschilds, Bronfmans, and tech moguls. Through these connections, he had access to Treasury officials, PayPal founders, and early stablecoin creators. Mark stresses that Bitcoin's early adoption cannot be understood without recognizing the human networks that surrounded it. Epstein's presence in these conversations illustrates how political, financial, and personal influence intersected with the early cryptocurrency ecosystem. However, Mark also cautions against conflating Bitcoin with these figures. It is a tool that has been co-opted and shaped by humans, but its value and purpose extend beyond any single individual's agenda. He further explains that the infrastructure and relationships established during this era still influence how Bitcoin interacts with traditional finance. Understanding these networks helps explain why some stablecoins dominate liquidity today, why certain exchanges gain traction, and why regulation has developed in the ways it has. For Mark, it's a reminder that financial innovation is as much social and political as it is technological. Mark delves into how political events, particularly in the US, intersect with the financial system to shape market outcomes. He refers to Trump as a chaos agent, whose first term created conditions that allowed new financial infrastructure, including stablecoins and tokenized assets, to flourish. Mark frames these events not as random chaos, but as a controlled, deliberate strategy that balances disruption with centralized financial objectives. He explores the way administrations manipulate public perception, creating the illusion of disorder while key financial moves happen behind the scenes. Mark predicts that events like the Fed's rate cuts and growing adoption of tokenized gold and Bitcoin are part of a calculated cycle, rather than spontaneous reactions. For investors, recognizing these macro patterns can provide an edge in navigating financial turbulence. Mark also emphasizes the psychological element. Market participants often react to headlines and political theater rather than underlying structural signals. By focusing on real financial flows, liquidity cycles, and policy decisions, investors can separate temporary noise from trends that have long-term implications. This approach, Mark argues, is how sophisticated players consistently outperform the broader market. The conversation transitions to investment strategy, where Mark provides deep insights into risk management. He challenges conventional wisdom about volatility, pointing out that most banks and funds mistakenly equate volatility with risk. In his view, true risk is not price swings. It is the potential for unrecoverable losses when the system fails. Mark positions Bitcoin as a unique asset in this context. Its volatility offers upside participation for investors while hedging against systemic risk in traditional markets. Over the past 5 to 7 years, he notes, Bitcoin has produced substantial returns relative to its drawdowns, rewarding investors who hold it as part of a diversified portfolio. For Mark, Bitcoin is not just an investment. It's a portfolio hedge, a tool to manage asymmetric risk, and a way to gain exposure to upside in a system designed for downside suppression. He also explains practical considerations for investors. Allocating small, consistent amounts of Bitcoin, keeping assets in self-custody, and diversifying across hard assets can dramatically reduce systemic exposure. Mark emphasizes that disciplined strategy, rather than speculation, is what separates those who thrive from those who get caught in market swings. Mark sees Bitcoin as more than an investment. It's a way to preserve sovereignty in a world dominated by centralized currencies. He compares Bitcoin to gold and the US dollar, highlighting how each serves a different purpose in a long-term strategy for wealth preservation. While he acknowledges the continued relevance of gold, he believes that Bitcoin provides the most growth potential and the greatest protection against centralized monetary policy. He emphasizes that Bitcoin can empower local trade, enable financial freedom, and provide a hedge against the concentration of wealth and power. Its censorship resistance and portability make it particularly useful in unstable regions or during financial crises. For Mark, these qualities are not theoretical. They're increasingly relevant as geopolitical and fiscal pressures intensify. Mark concludes that understanding Bitcoin's role in preserving personal sovereignty is essential for anyone planning their financial future. The ability to control your own money, reduce reliance on intermediaries, and insulate yourself from central bank policies may become just as important as traditional investment returns in the coming decades. Finally, Mark closes with actionable guidance. He warns against over-reliance on stablecoins or leverage systems, advocating instead for thoughtful positioning, diversification, and a focus on what you can control. He encourages viewers to educate themselves, act deliberately, and maintain exposure to long-term assets that preserve both wealth and sovereignty. Mark stresses that patience is a crucial part of investing. He notes that Bitcoin's adoption curve is gradual, and while headlines focus on short-term volatility, the real story is structural growth and increasing network effects. He urges investors to measure performance not by daily price swings, but by long-term portfolio resilience. He leaves a final takeaway. The financial system is complex, interconnected, and deliberately structured. Chaos may appear on the surface, but those who understand underlying dynamics and act with intention can position themselves to thrive. For Mark, success in the coming decades will belong to those who combine knowledge, strategic action, and patience in equal measure.